Good morning, and thank you for asking. Of course, it's a tragic conflict. As such, its economic consequences are, for the moment, broadly unknown. But what we can see is that we have to be mindful of the development of the oil market and the energy market. So far, the increase in oil prices has been relatively modest, and we will continue to monitor these developments. For the moment, in the euro area, inflation is stabilizing at its 2% target over the medium term.
I want to come on to the inflation outlook specifically in a moment, but looking back at the last time you spoke with one of my colleagues, Karen, in DC last April, you said in your view the biggest risk factor was the geopolitical situation in the Middle East. Now, obviously, the situation has moved on from where we were in April 2024, but I'm curious now, as you look out onto the horizon, you've got the U.S. declaring effectively a trade war on nations around the world, including the EU, but now this escalation in tensions in the Middle East. What would you say is the biggest risk to the outlook now?
We have both geopolitical high tensions and we have the ongoing tariffs or trade war, and both are very serious from the economic point of view and from the point of view of monetary policy. Given that context of continuing pervasive uncertainty, we are in a relatively good place in economic terms in Europe, so that the European economy is still growing, not super fast, not brilliant, but it is still growing, and it is showing resilience. And at the same time, inflation is stabilizing at around our target. In this context, we have to stay vigilant and we have to be alert in monetary policy to both directions because the uncertainty may have consequences both through the higher energy prices, which would raise inflation, and because of lower economic activity, which is weakening inflation. That's why we have to stay vigilant to both directions, upwards and downwards, and we focus on keeping the inflation expectations anchored around our 2% target. That's best for sustainable growth and high employment in Europe.
What do higher oil prices mean for Europe, and what would change the inflation picture in terms of the oil price?
If you look at the recent development of the oil price, first we saw in the past, say, half year, we saw lower energy prices, which was reducing inflation in the Eurozone. Now in recent week, we have seen a rise in the energy price or oil price, but it has been historically seen relatively moderate. And historically, if you look at the time series, oil prices are still not exceptionally high. Normally, we have a historical correlation so that, say, 10% increase on the Brent oil price is roughly equivalent to maybe 2 decimals of inflation. Of course, we don't know if this correlation holds today or in the future, but it gives you some kind of guidance as regards what kind of effect higher oil prices might have on inflation. As I said, at the same time, the trade war is impacting economic growth in the Eurozone, and we have for the moment several factors which are actually dampening inflation, and our baseline forecast from the European Central Bank is over 1.6% inflation in the course of 2026, which means we would be below target next year. ceteris paribus, depending, of course, on the very turbulent external environment.
Sir, you've said that the ECB, just in the last couple of minutes, is in a good position when it comes to policy, and that echoes what Madame Lagarde said at the last press conference, that the ECB is in a good position. But economists still widely expect another rate cut from the ECB this year. What would you have to see to support another rate cut?
Especially in the current context of pervasive uncertainty due to both geopolitical tensions and the US-inspired trade war, it makes full sense that we maintain full freedom of action. We don't give rate forward guidance in these conditions. We maintain full freedom of action, and I think I was cut now. Meni jonnekin yhteys katkesi.
Let me jump in, Governor, and ask you about the euro, which has risen against the dollar, and there's a lot of focus on the strength of the euro. What are you specifically watching with regards to the exchange rate? Is it the volatility, the pace of appreciation, or the absolute level that matters most to you?
Well, we don't have an exchange rate as a policy target, so we are observing developments over the, say, medium to long term and assessing its impact on inflation and growth, of course. At the same time, we are looking at more long-term structural issues, and for the moment, we are seeing that there is a certain comparative advantage for the euro as regards the stability of economic policy and democratic institutions. And I'm looking forward to the European Commission and the EU member states and the Parliament speeding up decision-making, for instance, concerning the Savings and Investment Union and concerning safe assets, so that we would have a more attractive and suitable liquid capital market for investors in Europe. That is part of the euro's global moment to which President Christine Lagarde has recently referred to.
Well, let me take that point a little bit further here and talk about the opportunity that Europe has at its doorstep right now. We're seeing investors reconsider their exposure to the United States. We're seeing researchers reconsider their postings in the U.S. and in many cases looking elsewhere for places to do research, for example. And many are saying this is the moment for Europe. This is the moment they've been waiting for, and it might not come round again. Do you think that Europe is doing enough to take advantage of this opportunity where a lot of top talent across sectors is looking to leave the United States?
First of all, I'm a friend of the United States, and I hope that the United States will succeed in the fields of the economy, finance, democracy, and the rule of law. Having said that, Europe has strong fundamentals, both in economic terms and in terms of societal development, stability of democratic institutions, and academic freedom at the universities. Certainly, we have to do more in many fields, including completing the single market, creating a savings and investment union to better mobilize formidable savings of Europeans to investment. And we have to improve our performance in the field of the universities and research innovation. That's a very meaningful policy agenda, and the European Commission and the member states, the Parliament, are very much engaged in that and making progress in many of these fields.